Hey traders, happy Tuesday. Hope your week is off to a great start. This is Ron at Market Tamer. As always, everything in this presentation is for educational purposes only. All right, we're going to kick off here with the SPY, the ETF on the S&P, down about 0.5% today. We pretty much finished right on the 20-day EMA in red. The 50-day in orange is your institutional moving average. We still need to get above that on a closing basis, just like I said about on the weekend video, as well as the days prior. Then the target is up here. Otherwise, the target is back down here to 282.50. This is still considered a bear flag. It's a big old flag, but it's also just simply a box. Now, I had some questions sent in that, and we're also asked on the YouTube channel too, about volume, news, higher lows, etc. It really comes down to the box, in my opinion here. We got to break out above here or break down below here, because the folks that bought in here that tried to bottom fish, if we end up closing below there, that's just going to add to the selling pressure. They're going to realize they're wrong, and that puts the target down here. The folks that were shorting up here, we break out above here, they're going to want to cover in theory, and the target is up here. Volume is important to me. I mean, if you gave me only two little tools to trade with, I'd want to do candlesticks and volume as only two little indicators on a chart. So that's how important volume is to me, and also candlesticks. But sometimes you can have rallies on light volume, sell-offs on lighter volume. It's always better when the bigger volume is there, but even if it's not, those are the technical targets. Just make sure you're keeping an eye on those. As far as news goes, I was chatting with some folks this weekend over the holiday, and they were all talking about the tariffs. Maybe that gets resolved, the market can resume its uptrend. And all they said is, as the question to more than one of them, was, do you know how much impact the tariffs will have? No one could give me an answer. I said, when there's an announcement of 100 million new tariffs, do you know what percent of that is of the economy? Do you know how much that product is going to increase in price? And again, it was crickets. No one knows. So that tells us, as traders, the media is doing a wonderful job of scaring the crap out of everybody. Now, that doesn't mean they're not buying as many soybeans, which they're not, and other things, and there aren't other impacts around. But keep in mind, the general media hates the current president. So as a whole, it's going to be constantly negative, negative, negative. Whether you hate him, whether you like him, this is not a political channel, so don't be making political posts. My point is, like I've always said in these videos, put your fingers in your ear, ignore all the news, and let's just allow price action to work. Because the one thing we all have in common, we all want to try to make more money, right? That's at the end of the day. So that's what I'm going to focus on, which is why I don't focus on the news on a nightly basis. If you go to some other websites, you're going to see they're leading out with, oh, the Dow is down 300 points today because of this. Like they know. It's a laughing stock, but they got to write an article. They got to sell clicks. There was just more selling today. Big deal, right? So they're always trying to find a reason for something, yet it's pretty much worthless information. And that'd be my 2 cents. So if we take a look here at the Dow ETF, the diamonds, it's going to be pretty similar to that of the S&P. Right at the 20-day, we still need to get above the 50-day, which is where we got to on Friday. Then we were rejected. Then we got to watch down here. If we go to the Qs, QQQ, there's the peak. You can see the higher lows here too. I mean, frankly, the fact that we are getting higher lows is positive. I think somebody commented about that too. But the reason I'm not really commenting on it, it's still a box. If I draw a trend line in here, I'm not going to go crazy bearish just because the trend line breaks. I think it's really all about that 180. The first warning shot's going to be right in here around 182, then 180, and then down here. If you want to see what a trend line would look like, for a trend line to be, quote, a trend line, you need to connect about 3 points. So I could connect 3, 4, almost 5 points doing something like that to give you perspective. But again, I think it's all about that 180 area. And the upside, even the 50-day is just perfect. It's around 189. That's what I would keep an eye on there too. You take a look at the QQQ, down about 1%. There's that rising trend line again. There hasn't been much talk about this, which I'm a little surprised, but there is a head and shoulders forming. The head would be the July high. The left shoulder is out there in April and May, and the right shoulder is now. It doesn't need to be symmetrical in terms of shape or even in terms of time. This qualifies for a right shoulder. Now, the neckline is the issue. That's one crooked neckline, right? It's also why I'm not talking about the head and shoulders pattern. But below 180 on the Qs is something you need to keep an eye on. Now, the Russell 2000, it continues to underperform. I'm bringing a 2-year chart of IWM. And in fact, let me just delete all these drawings. There was the high in August and September. This thing has never come back, yet the market has moved higher. Under ideal circumstances, you would like the Russell, the IWM, the mid caps, your M as in Mary, D as in Delta, Y as in yellow, them both to be tracking with the S&P and tracking higher with the Qs and the Dow. They're not. This is a negative divergence. But to be short the whole market just based off the IWM underperforming, I don't know that that would be a road to riches sort of situation. I would consider just trading the index, the security, the ETF itself, worry about that and not just because something is diverging. But yes, this is an absolute divergence with the IWM being where it's at. We've said that for a while. Watch 145 though. Then it comes down to 125. It's a huge drop. Otherwise, it needs to get above 160. If I bring in MDY, they were down 1.2%. Now they got a little closer to their previous highs. The rut is definitely the worst performer, the most lagging. But watch about 330. Otherwise, you get above here, and then it's a short trip to your highs. But the MDY, your mid caps, they're also using that 20-day pretty much. I mean, they didn't do it Friday, but otherwise they're still chopping lower. This is still a downtrending channel. When we would break out of this, that would be a sign, hey, maybe we're seeing a bit of a trend change. But in this example, even if it breaks out of this little downtrending channel, it's got the 50 to deal with. Once it gets above there, then there's a quick $12 trip back to those previous highs at the end of July. Now, let's talk about gold and silver and divergence. Here is gold up 1.39%, another $2 or about 20 bucks an ounce. It just started exploding in June. Now, seasonally, 7 for 7. This stock, this ETF, has gone up over the January timeframe. It's about a 6-week period you want to pay attention to gold. That does not mean we can't trade it bullish or bearish at different times of the year, but you don't have that seasonality effect. Here you have the pop, and the volume came in, and it's pretty much been an easy ride up, right? Silver had been lagging for a while. It is now making up for this. There's been some extraordinary gold-silver ratios that have been talked about. This one here, we are playing major catch-up now. Silver is just exploding. It is way overbought on a daily chart. If I take you back to a 5-year chart of silver, we're still not at the highs from 2016, which were around 19. If I bring in gold, you can see gold on the 5-year chart has already blown through that. So in a sense, gold's outperforming that way, but silver is now playing catch up. So target on the weekly is up there around 1950, which is only about $1.80 or so, $1.70 higher. Take a look at the gold miners GDX and look at a 1-year view. Again, volume came in, got above the 50-day, and off she went. This is still bullish. If we look at SIL, the silver miners, it was up 3% today. There's your cross. It's moving up. The 20-day on the miners and even gold and silver hasn't worked the best, and nothing ever will be perfect, but it's gotten below, gotten back above, gotten below, gotten back above. Maybe the 50-day might be something else to consider as a potential trailing stop. I got some questions on stocks we don't always talk about a lot. YETI, Uber, LYFT, and we'll take a look at Activision too. Here is YETI, and the question is, it's come off its recent highs. We have a double top. Now, this stock is only publicly traded. Just to show you, I'm going to go back 2 years. And what you're going to see is nothing changed. That's right. The stock went public about 11 months ago, back in October. So looking at this 1-year view, we do have a double top up there around 36, 37 bucks, and we're coming down. If it breaks this $23, $23.50 area, then there's a gap to fill down here. But right now, if we zoom in, the red line is acting as resistance. It's channeling. You should be able to visually see the lower highs and lower lows. There's nothing bullish about this stock. Before YETI could become bullish, it needs to get above first the red line to at least change the short-term momentum, but then back above the 50-day in orange. Now, LYFT and Uber, they are fast-tracking lower. LYFT has broken to new lows since it came public in March. Where is the bottom? Stocks do stop at 0. I'm not saying it's going to get there. We could try to use fibs or something or extensions, blah, blah, blah. Elliott wave, which I am not a fan of. It's no different than having a marker and an eraser, pencil and an eraser there. But it's bearish. We need to get above the red line, at the very least, to show the downward momentum is dropping. Here is Uber, down 5%. Again, below its lows in May, same thing, needs to get above its red line. I would not try to catch falling knives here. There's nothing bullish about this. So, sure, use your favorite technical analysis, Ichimoku, Elliott wave, Gann, whatever it might be. but the things are bearish. And until we get above something, it's still bearish. And last but not least is Activision. Look here, we are staying above these previous highs. This is bullish, but we still have these little highs here, which is interesting. I would consider a 20-day EMA as an end-of-day trailing stop. And something else I want to tell you guys about. I haven't held one of these webinars in over a month and a half. I am now going to host a See the Top 10 Stocks for September. It's this Thursday, as in 2 days from now. I just put the invitations together today. I only have 500 seats. If you've attended my sessions before, you know they're going to max out. You can ask a friend to attend. If you're watching this because you got an email, forward the email to them, but please register ASAP. And then you want to show up at least 30 minutes early. I open the webinar room about an hour early. You want to get in there, and then you do not want to leave. I'm not going to record it. There's no replay because I want everyone in their seats. Regardless what the market wants to do, up, down, doesn't matter. So some stocks historically rip higher even when the market crashes. Some go down even when the market rallies. Knowing which stocks historically do that 80, 85, 90+% of the time is an incredible edge. And you guys know when I do these open house events, which is what this is going to be periodically, you guys jot these stocks down and then you send me the email saying, oh my God, I cannot believe it worked again. You know, past performance is no guarantee of future performance. Nothing ever works 100% of the time. But how many times have you watched a stock go nowhere, and the moment you buy it, it seems to go in the wrong direction? Or better yet, the market goes nowhere, and then you look at the biggest gainers and you say, man, I wish I could have known which stocks typically track higher for September and October and into year end. Well, that's what I'm going to show you. And the best part is we're going to use the stock's own track record as our secret weapon. It's going to be our treasure map, our GPS. So I plan on blowing you guys away. Please go ahead and register. Again, it's going to be noon Eastern this Thursday, September 5th, okay? So with that, I'm going to say, hey, have a wonderful week. I hope to see you at the webinar. And take good care. See you tomorrow.